My name is Daniel Krug. I am the CEO and Senior Wealth Manager at Daniel Krug and Associates. I am going to be the single presenter today. Rocky is out in California with a brand new baby grandchild. So the next time you see him, tell him congratulations. He's enjoying his time out there with the grandkids. We do have some disclosures. I'm not going to leave this on too long, but let me get my face out of the way so you can see the whole thing. And you can also see this on the website at Daniel Krug and Associates YouTube, where you can see all the videos. Housekeeping for today. This is going to take about 30 minutes, so we're going to try to keep this really quick and concise. The session will be recorded again, so you can go back to our site to be able to take a look at it. Everybody will be muted. We will use the chat room for any kind of questions, or if you just want to say hi. We want to thank City National Rockdale for their contribution. We couldn't do this without them. They are just a great back office, do a great job of research, and it does help with everything we do moving forward with our clients. Now, again, this is wealth management. So today we're focusing on investment strategies and wealth enhancement strategies, where you're looking at portfolio management, tax mitigation, financial planning, cash flow planning, liquidity planning, all that. It's just part of what we do. It's in our DNA. For today's agenda, we're looking at major developments this week. I'll talk a little bit about what's really popped up over the last 2 weeks. The COVID-19 update, we'll talk a bit about Michigan and also about the U.S. The economic impact and policy responses. We'll talk a little bit about the economy, where it's going and how it's pushing forward. And then looking at incorporating goals into portfolio management, which is again what we do, the tactical side of managing for clients. We'll look a little bit into opportunities, and then we'll get into question and answer. So we're going to start out with major developments. So the S&P 500 hit an all-time high again this last week, really led by technology shares. The technology shares are really pushing the S&P 500 ahead by about 5% over the S&P X, the 6 largest tech stocks out there. So technology is really driving it. The Democratic Convention established their policy platform, and the probability of a Democratic sweep for all 3 branches has actually increased based on the polls out there. The COVID flare-ups in some parts of Europe are kind of a little bit dramatic, especially in France and in Spain. So both of those areas are working to get it back under control. The rest of Europe is in pretty good shape. Vaccine. The vaccine is in the late stage trials, due in the next 1 to 3 months. That's a big deal. The concern is that there's only about 50 to 60% of the people out there that are willing to be vaccinated. They'd like to see 75% to get that herd mentality. Who knows? We'll see what happens. That's a personal choice for everybody. There is a high savings amongst the individuals, and that is really driving consumption right now. Spending is relatively high despite unemployment. So a lot going on there. Fiscal stimulus failure. The global monetary and fiscal stimulus has really kind of pushed the economy this year. But with the House on vacation, there's really not a whole lot of communication going on between the Senate and the House, and therefore we're kind of stalled. We do believe it's going to happen, but it may not happen until the recess is over. Equity valuations are high. What does that mean? The risk of correction, it's higher, much higher, but it's difficult to time. Portfolio allocations, because of that, continue to emphasize risk management. And then the layoffs and bankruptcies for mid and large businesses are really increasing. Matter of fact, there's about 80,000 businesses that have basically shut their doors because of closing down the country. That is going to have a long-term effect on unemployment and on obviously businesses in general. But that being said, the U.S. is still recovering faster than any other country right now. So that's a positive. So let's look at the updates. We're going to start with Michigan. Michigan, you've probably seen this chart before in this heat map from the state of Michigan. It's directly from their website. About 2 weeks ago when we had a workshop, you would have seen that the Upper Peninsula and Traverse City were in blue. Again, Michigan's broken down into 8 regions. The 2 top regions were blue. The rest of the regions were improving. Kind of looks like what Traverse City is right now. The problem that we're seeing out there is there's really no clear criteria as to why we're closing up more relative to opening up. And we're looking for a little bit of guidance from the governor on that. If you look at Michigan statewide, the daily tests over time are increasing. They're getting much higher. So that's a big deal. If you think about it, from April 1st of this year, we are now 7.7 times the amount of testing as of August 24th than we were in April. So the testing is out there. What would you expect to see? You would expect to see more positive rates out there. Now, that being said, the statewide positivity test is actually been pretty stable over the last 2 months. So you can see by this chart that the current rate of positivity is at 3.3%. You go back to April and it was at 35.8%. So much higher in April. We've really got it down to a low, very low, medium, or low category. They expect it to really stay at this level until a vaccine is in place. Now, the issue here is if we've got the level down so low, can we open up? And we'll talk a little bit about measures that should be taken that could allow us to do that. You're looking at the overall statewide deaths over time from April, which the average death rate for 7 days was 82. Now it's down to 8. So again, everything has come down and stabilized at this point, and that should really be good news for everybody. If you look at the U.S., we had a bit of a surge, but again, as you open up different states, you're going to have different states that spike as they open up and get things rolling, and other states that are reopening. But that being said, when you're looking at the cases and hospitalizations, they're still on a downtrend. Matter of fact, 90% of the U.S. population is below a transmission rate of 1. What does that mean? Well, for every 1 person who gets it, less than 1 person will catch it from that person. And that is one of the reasons why this is going down right now. So the average fatalities for the U.S. is less than 1,000 over the 7-day average. And this is the first time in a month. So that's a very positive thing. Texas, Florida, and Arizona, which were quite positive about a month ago, have seen their cases drop dramatically. So everything is kind of moving in the right direction. Now, when you talk about what is the right measure to close down, to curtail the virus and have the minimum mortality rate, well, MIT did a paper on this and they did a study. And what they found that it is possible to achieve a safety result of lockdowns with more targeted approach and not a total lengthy shutdown. So what this chart shows is that on the left-hand side, you've got a lengthy total lockdown, which would cost about $8 trillion. You swing all the way to the right, and you've got targeted group distancing, improved testing, and isolating, and the cost of that is about $1.5 trillion. Seriously lower. And the interesting thing is, all 5 of these different options have a result of a mortality rate of about 0.2. So we can spend a whole lot less and do the same job. And hopefully what the government will do is take a look at information like this and say, all right, let's get more targeted in what we're doing so we can get the economy moving again and actually save businesses, save jobs, and save lives for everybody who's been unemployed and shut in. Now, here's some more good news. When you think about the Operation Warp Speed relative to the vaccine, generally it takes a long time to get FDA approval, but they have absolutely fast-tracked the approval and the process. So when you're looking at process of how do you get a vaccine from point A to Z, in other words, from inception to actually distribution. Well, in this case, the R&D and initial safety trials were running between January and May. The safety and efficiency trials, which typically take 42 months, were running from June to November. Now you look at the upcoming months, they're expecting distribution to start between December and February. Typically that takes about 6 months. So they are fast tracking this to try to get this vaccine out much earlier for everybody. So again, good news out there, and it bodes well for opening up. Now let's look at the economic impact and the policy responses. When you look at what's going on with the economic impact on housing, the interesting thing here is that it seems like the housing industry didn't get the recession memo. In other words, when you go back on this graph from 2000 all the way to 2020, what you're going to find is that during the last recession, it took from 2006 to 2018 for people to get back to where they were from a value standpoint in your house. Right now, though, when you look at it, yes, there was a momentary drop in the prices, but it came right back. The production and the activity is still there. So currently, we're at a 15-year high. This thing's moving along quite nicely. And that's actually going to bode well for recovery. When you think about the household net worth, it really rebounds. And because it rebounds so well, it actually allows the recovery of the economy to rebound better. So not only are the stocks and the market doing much better, but so is the housing. And what that means is that the GDP growth actually, if you look forward 6 months, historically, the household leads the GDP growth. So we're looking at pretty good things in the next 6 months, but we will have a bumpy ride along the way. I don't think anybody thinks other than that. When you go on and look at the jobs, despite the job losses, the households have had a capacity to spend. The gray area there shows you the real disposable income in billions of individuals in the United States. And then the dark line, the black line, is the personal savings rate. And as you can see over time, it maintains about the same level until 2020, and all these stimulus packages have been coming in. Now, how have the consumers been spending the stimulus checks? Well, 33% are saving the money, 52% have paid down debt, kind of like saving money, and then the other 15 has been spent. So there's actually a capacity to spend more out there, and that again bodes well for the economy if we can get ourselves opened up. So let's talk a little bit about the election and investing. Certainly if Trump holds the White House and the Republicans hold the Senate, you're probably going to see a status quo relative to economic policies trying to push the economy forward. Now, what happens, though, if there is a Biden win? Well, when you look at this chart shows the current polling data on the Senate race. Now, let me get my head out of the way there. What you have here are 7 key states out there. And currently, the Republican Party holds the majority. However, the polling is showing that many of these could go to the Democrats. If that happens, then they certainly could take over the Senate at that point, which says that if the House, which everybody expects to say Democrat, and then the Senate goes over to the Democrats, and then the executive branch goes there, well, you got a sweep of the three branches. Now, let's move forward and take a look at how that could affect the economy. So again, we know what Trump's going to do. Let's talk about what the Biden's proposal is going to be. Well, we know there's going to be tax increases, and specifically on corporations, there is going to be a tax rate hike. So they're expecting that the rate hike will go up to around 28% rate. Now that's a sizable increase. And that would actually reduce the earnings on the S&P 500 companies by between 8 and 11%. And you know that the better the earnings, the better the stock market goes. The less earnings, the lower the stock market goes. So it is an issue out there. So what we're looking at is, if Biden does get in, how's it going to affect different industries, and how do we need to invest relative to that? Well, the reality is it's going to hit a lot of the industries pretty equally, but the best is going to be the industrials. The worst hit is probably going to be the technology sector. And it's a profit issue. So keep this in mind, because this is a cascading effect. So if you have the profits go down in companies, they've got to find a way to boost it back up. They've either got to be very innovative to increase their productivity, or they've got to decrease their expenses. And often what will happen is it turns into a little bit of an unemployment issue, which ultimately doesn't bode well for the economy. But at the end of the day, this is what we're looking at through the research from a 28% tax rate for corporations. Now, look a little bit further. There's other policies. On the technology side, you've got antitrust laws that could come into play, and the probability of that is actually pretty high. CNR's viewpoint is it will probably take years before that actually plays out. But again, a tax hike plus the antitrust is going to be a little bit disruptive. From a healthcare standpoint, there probably will continue to be a public option. So the single payer is kind of unlikely. When you look at the consumer's discretionary, they are looking at a minimum wage hike. That is very high on the probability list, and that certainly could hurt profits. And again, we're going back to the stock market on this, because if you have a rate hike, less profits, technology and policies that are put in that cut profits, and then you have a minimum wage hike, which cuts profits, it's a trifecta, and it will hurt the economy as the companies adjust. And it does have an inflationary aspect to it as well. Financials, low issues there, not a problem. Industrials, that could have a high likelihood of having some kind of environmental impact to the companies. In other words, improving the environmental outlook of how they produce goods. That would be a good thing, but again, penalties to get it done hasn't worked very well in the past, but we'll see how that actually plays out. But again, that could hurt profits. How does that look relative to the market performance? Well, let's look at this really from an incumbent party winning or losing. And what if a Republican incumbent wins or loses? How does the market react historically? And this chart actually takes the information all the way back to 1900. So we've got a lot of data here. If the incumbent party wins, well, there's a good chance that the year that they win there's going to be an average of a 15% increase. The following year, about 6%. So a mild following year. If the incumbent party loses, and this is both Democrats and Republicans together, this is a combination, the market goes down about 3%, and it goes up the following year about 8%. So an 8% gain is good, but the 3% loss takes away from that a little bit. If an incumbent Republican wins, there's usually an average of a 20% increase in the market, and that's followed by an 8% next year gain. Probably the best for the market. If the incumbent Republican loses, that year we tend to have about a 6% loss in the market. There's a lot of jockeying in the market to reallocate positions, and then the following year looks pretty good. But a 6% loss, again, kind of takes away from some of the gain the next year, but I'd take a 15% gain the following year, wouldn't you? So as you're looking at it, just from a statistics standpoint, looks like stock market would rather have a Republican, but who really knows? We'll see how this actually plays out. Now, let's say Biden wins and they sweep the three branches. What do you do if you're a high net worth and high income earner? Well, we've got to look at things that are going to be more tax free. And traditionally, most investors are going to be looking at muni bonds. But if you just look at the AAA munis or the 10-year AAAs, you're probably not going to be too excited about the rate of returns. On a 5-year, you're at 0.74% rate of return. And on a 10-year, you're at a 1.62. Well, that's not covering inflation at that point. So where do you go? We look at this point, high yield munis. Now, we're not talking about junk type stuff. We're talking about the best of the best on the high yield. In this scenario, the after-tax returns are looking at 7.5%. Well, most people would say that looks pretty good moving forward. And again, that shows you the tax-free equivalent. So if you're a high income, high net worth, have a lot of non-qualified money, the munis might very well be the place we're going to have to look should there be a sweep in the three branches of the government. How about incorporating goals into the portfolio management? We've done that. It's kind of in our DNA on how we perform on the market and in the portfolios. We look at the institutional managers that are actually looking at incorporating goals to their portfolio management to get the best you can get out of it. Let's kind of look at this example. What we want to really do is optimize the lifetime income. What this chart shows is an individual at age 40 who has $1 million. So they got another 25 years of investing going on. And as they invest traditionally, they work to retirement, and they've got a little over $3.2 million now saved. Fantastic. Well, they've got to take out about $300,000 in income. So as they go more conservative, because many people will get more conservative in retirement, they're going to find that the returns aren't there. And based on the amount they're taking, they're actually going to run out of money too soon. Optimizing for lifetime income is very critical, and it's why we do what we do. Let's take a look at how this works. On this chart, you've got really three sets of years. You got age 40, age 65, and age 75. The first part of the chart, which is highlighted, shows you the 40-year optimized portfolio. That's where you're looking at large cap stocks. You're looking at a lot of core US for that matter, investment grade bonds. You're looking at high dividend stocks, emerging markets, opportunistic income, and alternatives. So it's the allocation is really a better mixture and getting better returns. If you look at the traditional, it's more 75% equities, 25% bonds at that rate. Now, you move forward, and ultimately, what do you see? Well, at age 65 in retirement, you see the person get a lot more conservative because really that's what the industry tells you to do. But is it the best way to go? Well, we think not. In this situation, the optimized portfolio, yes, we did get more conservative, but we still stuck with the alternatives, opportunistic income, emerging markets, high dividend, because we know the returns are there. Then you go a step further, age 75, again, the traditional's more conservative, 60% bonds, 40% equities. We're not. We're looking at more alternatives, opportunistic, high dividend stocks and US stocks, giving us better performance overall. How does that work out? Well, it's a series of goals, right? Our approach is tactical. You know, when you're looking at this, City National Rockdale calls it glide path optimization. We call it tactical optimization. Our approach targets income goals, volatility, wealth balances simultaneously. So we're looking at everything. Each year of income can be viewed literally as a goal in itself. So we look at each one of the asset allocations and we review them individually. So it's more tactical. And as you can see on the left-hand side of this chart here, income year one, well, optimized performed better all the way through year 10. I don't know about you, but in income year 10, 260,000 optimized looks better than 210. So it just works more efficiently for clients and investors as a whole. So let's take a look at this chart again. If you improve the optimization of the portfolio, the black line shows the individual in a traditional path. In other words, 40-60, 60-40 portfolios. But when you look at the optimized graph, you can see that the performance is better. The income ultimately ends up better. So we believe in this. It works very well for our clients. You add additionally to this advanced planning, and you got a home run at that point. And that's why many of our clients are not having, actually, I don't know of any clients are having problems retiring comfortably and the way they want to. So it works out well. It's something that we don't plan on changing. Obviously, if the industry change, we'll tactically adjust with it. But right now, it looks pretty darn good. Let's go on to the market. The PE ratio is up again. Currently, we're at 28.32. We're kind of going off the charts here. We are definitely overvalued in the stock market. So we're taking more of a precautionary look at the overall portfolios at this point as we are moving forward. Many of you might have seen this chart on here before. The economy, you know, it's going to recover. We know it is. The pace is a little bit uncertain because it really is dependent on opening up the country, which is, you know, largely dependent on the tactics we use to control the virus. But what we're thinking is the V shape really is not going to happen. It's not very likely at this point. The U shape becomes more likely, and the W shape is becoming more and more likely. Certainly, the more the valuation gets out of control, the more you're going to have a correction, generally speaking. It's kind of like a rubber band. The more you pull it back, the harder it's going to snap the opposite direction. So when you're looking at the economy, we are still looking for a correction here moving forward. We're just not sure when it's going to happen. When you look at the market today, you know, most people would look at this and say, well, that looks like a V shape. But again, this recovery is not over yet. We're still looking for what we need to adjust when the market does correct. We're looking also at the blue area that will hit, or more probable area that will hit, when we do the remainder of the strategies that we have in place. So that kind of brings us to the opportunities. You know, our strategy playbook calls for 5 strategies. Two of them we've implemented and have been implementing along the way here. That's strategy one, active management and reallocating the sectors. And number three, the draw and let heal strategy. Those two are in place, and they're certainly helping our clients get back to even faster. The three that we have not implemented yet, but they are in place at this point, is strategy number two, Roth conversions, strategy number four, reallocating risk up, and strategy five, buy low. As we move forward, we will be implementing those once the market makes the correction. If you want to see the manner in which these portfolios are adjusted based on the different strategies, you can go to Daniel Krug and Associates YouTube channel. When you put that in the search bar, you'll see this come up where it says Daniel Krug and Associates YouTube. Click on that. And ultimately, what comes up after that? Our channel. And you will see all of our different videos out there. So you can go back and look at the history of all the webinars that we put on. More importantly, if you have a specific strategy you want to take a look at, we have broken down each one of these webinars into segments. So 1 to 4 or 1 to 5 segments. You'll find that the opportunities tend to be in section 4 of 5 of the different videos or workshops that we've done. You can see that we have the reallocating risk up, where you can see exactly how that strategy works, Roth conversions, active management, draw and let heal strategy. They're all there. You can take a look at them when you want to, really get a good feel of how they work. We've added some numbers into the strategies so you can kind of get a real dollar sense of what goes on with those strategies. That's the YouTube channel. Now we're up to questions and answers. Now, since I do not have Rocky here, what I'm going to do is I'm going to go over to the chat and see if there are any questions. We've got, here's a question from William. Is there a minimum dollar amount to invest in the high yield munis? Well, okay, the answer to that is going to be yes and no. And I know people don't like that answer. Yes, you can get into high yield muni ETFs, but most of them aren't going to be institutional. What you really want to get into, if you're really targeting a specific quality, is into the high net worth solutions. And generally, you're going to need $1 million to invest into those high yield solutions, but not all the money has to go into the munis. In other words, they're just looking for an aggregate dollar amount of $1 million to invest for you. And you could put 30% in the high yield munis and reallocate the rest of the money in other portfolios. So very good questions. Another question, can I share this link and videos with my kids? You know what? I would love for you to share these videos with everybody that you know. I think this is information that needs to get out to the public. Why? Because most of the money managers, most of the financial advisors are not going down this road to tactically manage the portfolio and optimize the income for their clients. And certainly, as you've heard us talk about before, only about 5% of us wealth managers out there are really wealth managers. What does that mean? That means that we're actually doing what wealth managers do with all the advanced planning, with all the collaboration with the other advisors that you have, to make sure that you know you're going to get where you want to go. So it's something that I would say get information out there. At the very least, people can get another thought and bring it to their advisor. Maybe their advisor can help them. If not, hey, we're always here. So we're there to help in any way we can. I'm looking to see if there's any other questions. Nope, that's pretty much it. Again, Rocky's out of town for about a week and a half here. He'll be back after Labor Day. What does that mean? It means that he's having fun in sunny California while we're having fun in sunny Michigan. A little bit humid for me, but it's Michigan. So when he gets back, congratulate him on the new grandchild. I'm sure he'd love to see that. But that being said, let me see. I think that's probably it. Yep, that is it from a question standpoint. So what I'm going to say is this. You take care of your family, and we will take care of you. We are always there. We're ready. We're looking at the market. We're looking at the economy. We are making adjustments as we see fit to make sure that you optimize everything that you have. So with that, I'm going to sign off, say a goodbye to everybody, and hey, have a great weekend coming up here. Bye-bye.